Imagine standing on the edge of a cliff, looking down at the ocean. For the last 20 years, investors, governments, and global corporations have been convinced that the tide is rising. They have bet trillions of dollars on a single, unshakable belief. The belief in the commodity supercycle. The idea that as the world gets bigger, as populations grow, and as technology advances, we will inevitably need more copper, more oil, more steel, more wheat. They told you that scarcity was the future. They told you that the only way for prices to go is up. They told you that if you owned the raw materials, you owned the future. But look closer at the water. The tide isn't rising. It's going out. And it is revealing something terrifying at the bottom. We are not entering a golden age of resource wealth. We are standing on the precipice of a historical collapse in demand. Not a temporary dip, not a recession, but a permanent, structural destruction of value. The mines are digging for ghost cities. The tankers are shipping oil to factories that are shutting down. And the narrative you have been fed about a resource-hungry future is the biggest economic lie of the 21st century. Prices aren't rebounding. And today, we are going to break the 4 myths that convinced the world they would. This is the story of the Great Stagnation. If you want to understand the economic reality that the news is too scared to show you, and if you want to survive the financial shift that is coming, make sure you subscribe to the channel right now. Hit that like button and comment below with your take. Do you think we are running out of resources or running out of buyers? Because the answer to that question determines who wins and who loses in the next decade. Let's get into it. Let's start with the first pillar of the lie, the China narrative. For 30 years, the entire global commodity market was built on one simple equation. China builds, the rest of the world sells. It was the greatest transfer of physical wealth in human history. Australia dug up the dirt. Brazil grew the soy. Chile mined the copper. And China bought it all. Every skyscraper in Shanghai. Every high-speed rail line in Hunan. Every massive bridge to nowhere was a paycheck for the rest of the world. It created a psychological addiction. We assumed that even if the West slowed down, the East would always be hungry. We looked at the charts, and we just drew a straight line going up forever. But that line has broken, and nobody wants to admit it. We aren't just looking at a slowdown in Chinese GDP. We are looking at the mathematical end of an era. You have to understand the scale of what China did. Between 2011 and 2013, China used more cement than the United States used in the entire 20th century. Think about that for a second. In just 3 years, they poured more concrete than America did in 100 years of building New York City, building the Hoover Dam, building the interstate highway system. That level of consumption isn't normal. It isn't sustainable. And most importantly, it cannot happen twice. Once you build the bridge, you don't need to build it again. Once you build the apartment complex, you don't need more steel for it. You just need maintenance. And maintenance requires a fraction of the raw materials that construction does. But the myth persists. Wall Street analysts keep telling you, China is reopening. China is stimulating. The demand will come back. No, it won't. Because the people who were supposed to live in those apartments were never born. This is the dark secret behind the demand collapse. Demographics. China's population isn't just aging. It is shrinking at a speed we have never seen in a major industrial power. They are facing the 4-to-1 problem. 4 grandparents, 2 parents, 1 child. That 1 child cannot buy enough houses to support the market. Fewer young people means fewer new families. Fewer new families means fewer new homes. Fewer new homes means less steel, less copper, less glass, less plastic, The real estate sector in China consumes nearly 30% of the world's iron ore. Just one sector, in one country. And that sector is dead. It is a zombie. The developers are bankrupt. The cranes are still. And the millions of unfinished units sitting in the provinces are monuments to a demand that simply does not exist. Yet, global mining giants are still expanding. They are still projecting growth based on a model of China that died in 2019. They are bringing more supply online, just as the biggest buyer in history is closing its wallet. This is the definition of a trap. We are looking at a surplus of everything, colliding with a vacuum of demand. And that is just the first myth. Because while China is fading, the rest of the world is changing how it uses stuff entirely. This brings us to the second myth, the tech salvation myth. The belief goes like this. Sure, traditional infrastructure is slowing down, but look at technology. Look at AI. Look at the metaverse. Look at electric vehicles. We are going to need so much metal to build the future. It sounds logical. It sounds smart, but it is completely wrong. Technology does not increase the consumption of raw materials in the long run. Technology acts as a deflationary force on matter. It makes us efficient. And efficiency is the enemy of volume. Think about the device you are watching this video on. Maybe it's a smartphone. 20 years ago, to do what that one phone does, you needed a camera, a GPS unit, a flashlight, a CD player, a DVD player, a physical calendar, a calculator, and a stack of paper maps. All of those things were made of plastic, metal, glass, and silicon. They were manufactured in factories that used energy. They were shipped on trucks that used oil. Now, all of those physical objects have been dematerialized. They have vanished into software. They are just code on a screen. That is massive demand destruction. And it is happening everywhere. Look at the industrial sector. We are entering the age of precision manufacturing. In the past, if you wanted to make a car part, you took a big block of metal, and you cut away what you didn't need. You wasted 40% of the material as scrap. Today, we use additive manufacturing. 3D printing. We use exactly the amount of metal needed, down to the micron. Zero waste. That sounds great for the environment. It sounds great for the profit margins of the manufacturer. But for the mining companies selling the metal, it is a disaster. It means for every car built, demand for raw steel drops by 20% or 30%. Scale that up across the entire global economy. Billions of units. The demand curve is being eroded from the inside out. And then, there is the substitution effect. This is the part the bulls always ignore. When the price of a commodity gets too high, we don't just pay it. We innovate around it. We find a way to kill the need for it. Look at cobalt. A few years ago, everyone said cobalt was the new gold. You need it for EV batteries. Most of it comes from the Congo. It's scarce. Analysts predicted prices would go to the moon. So what did the battery makers do? Did they panic and pay up? No. They invented batteries that don't use cobalt. Tesla and Chinese manufacturers shifted to LFP batteries, lithium iron phosphate. Cheap. Abundant. Cobalt prices crashed. The supercycle for cobalt ended before it even really began. This is happening with copper too. Everyone says we will run out of copper because of the grid. But aluminum is already replacing copper in high-voltage transmission lines. Graphene is being tested in labs right now. Technology is not a loyal customer. Technology is a ruthless optimizer. It hates inefficiency. And digging rocks out of the ground to move them halfway across the world is the ultimate inefficiency. So we have China stopping the build-out. We have technology reducing the material intensity of growth. But surely we are running out of stuff. right? Surely the mines are empty and the wells are dry. That is the third myth. The scarcity narrative. And it is perhaps the most dangerous one of all, because it relies on a misunderstanding of how human beings react to prices. We have been told for 50 years that we are at peak oil, peak copper, peak everything. In the 1970s, the Club of Rome predicted we would run out of oil by the year 2000. They were smart people. They had data. But they were wrong. Why? Because they looked at proven reserves. They looked at what we had found, not what was actually there. Here is the truth about the Earth. It is massive, and we have barely scratched it. Every time we think we are running out, we develop a new pair of glasses to see what is underground. Fracking technology unlocked billions of barrels of oil that we knew were there, but couldn't touch. Suddenly, the U.S. became the biggest oil producer in the world. The scarcity evaporated overnight. Now, apply that to metals. We are developing AI-driven exploration techniques. Satellites that can scan the crust of the Earth and identify deposits deep underground. We are looking at deep-sea mining, where the ocean floor is literally covered in polymetallic nodules. Just one zone in the Pacific Ocean, the Clarion-Clipperton Zone, contains more nickel and cobalt than all known land reserves combined. The moment prices tick up, that supply unlocks. There is no physical scarcity. There is only economic scarcity, and technology is lowering the cost of extraction every single day. Now, you might be thinking, okay, but what about the inventory reports? I see the news. They say stockpiles are low. London Metal Exchange warehouses are empty. This is the fourth myth. The inventory illusion. Wall Street loves to show you charts of low inventories to scare you into buying. But low inventories today do not mean what they meant 20 years ago. The world has changed how it handles logistics. We live in the age of just-in-time everything. Nobody wants to hold inventory anymore. Inventory is expensive. You have to pay for storage. You have to pay for insurance. You tie up your capital. Companies have used AI and better logistics to run their supply chains razor-thin. They don't keep 3 months of copper on hand. They keep 3 days. Because they know the ship is coming. They know the train is on time. So when you see low inventories, it doesn't mean there is a shortage. It means the supply chain is efficient. It's a signal of speed, not scarcity. But the market misinterprets this. Every time inventories dip, speculators rush in. Oh no, we are running out. They bid the price up. This creates a false signal to the producers. The miners see the price jump, so they dig more. The drillers see the price jump, so they pump more. They flood the market into a demand void. And then, the price collapses. We are stuck in a cycle of false signals. And right now, the signal is flashing red. Because while the visible inventories are low, the shadow inventory is massive. Strategic petroleum reserves. State stockpiles in China that nobody knows the true size of. Recycled metal sitting in scrapyards waiting for a better price. The moment there is a squeeze, this shadow supply hits the market and kills the rally. We are swimming in stuff. We are drowning in capacity. But the narrative keeps telling you we are thirsty. Let's move to the most controversial part of this analysis. Argument number 5. The green transition trap. This is the holy grail for the commodity bulls. Green energy is material intensive. Solar panels need silver. Wind turbines need steel. EVs need copper. This is true. But there is a fatal flaw in this logic. The green transition is a one-time build. Think about it. When you build a coal power plant, you need to feed it coal every single day for 30 years. That is continuous, recurring demand. The miner loves that. He has a customer for life. But when you build a wind farm, You buy the steel once. You buy the copper once. And then it just spins. For 25 years. It consumes nothing. It generates energy without generating demand for commodities. The transition to renewables is actually a transition away from recurring consumption. We are front-loading the demand now to destroy the demand later. And even that front-loaded demand is overstated. Look at what is happening with solar. Silver usage per panel is dropping every year. Engineers are thrifting it out. Look at wind. We are making turbines bigger and more efficient, so we need fewer of them to generate the same power. The efficiency curve is faster than the installation curve. And here is the kicker. Recycling. The first generation of solar panels and wind turbines and EV batteries is about to reach the end of its life. We aren't going to throw them away. We are going to grind them up. That copper, that lithium, that aluminum, it comes back into the system. The urban mine will compete with the actual mines. In 20 years, a huge chunk of our supply will come from recycling loops, not from the ground. That is a nightmare for commodity prices. It turns a scarcity model into a circular model. And in a circular model, prices trend towards the cost of recycling, not the cost of extraction. So where does this leave the producers? Where does this leave the countries that bet their future on high prices? This leads us to argument 6, the geopolitical consolidation and the crisis of the producer nations. If you live in Canada, Australia, Brazil, Russia, or parts of Africa, this is the part that should worry you. These economies are addicted to the export of raw materials. Their currencies, the Canadian dollar, the Australian dollar, the Brazilian real, are proxies for commodity prices. When commodities crash, these currencies crash. We are looking at a future where these nations get poorer relative to the tech-producing nations. The wealth transfer that happened from 2000 to 2012, where money flowed from the US and Europe to the emerging markets, is reversing. Capital is flowing back to the owners of IP, to the owners of AI, to the owners of the brands, and away from the owners of the dirt. This economic pressure is going to force a brutal consolidation. The big mining companies know this is coming. Why do you think BHP and Glencore and Rio Tinto are trying to buy each other? Why are they engaging in mega mergers? Because they know they can't grow through volume anymore. If the pie isn't getting bigger, you have to eat your competitor's slice. They are preparing for a low-growth, low-margin world. They are circling the wagons. This means fewer jobs in the mining sector. It means ruthless cost-cutting. It means automation. The days of the mining boom, creating entire towns in the middle of nowhere, paying truck drivers 6 figures, are over. The autonomous trucks don't need a salary, and the consolidated giants don't need as many mines. They will high-grade the best deposits and shut down the rest. This is the stranded asset problem. There are billions of dollars of copper and oil and coal in the ground that are listed as assets on company balance sheets that will likely never be dug up, because at these future prices, it simply isn't worth it. Those assets are effectively zero. But the stock market hasn't realized it yet. Now, let's escalate this to the final argument, the psychological shift, the end of the inflationary mindset. For the last 3 years, everyone has been terrified of inflation. We have been terrified of prices going up. But the structural forces we have just discussed, demographics, tech efficiency, the circular economy, China's stagnation, these are all deflationary, massively deflationary. We are fighting the last war. Central banks are raising rates to fight inflation, while the real economy is preparing for a price collapse. When this snaps, it is going to snap hard. We could see oil fall to levels that bankrupt nations. We could see copper stay flat for a decade. This destroys the investment case for the value trade. Investors fleeing tech stocks to buy hard assets are running into a burning building. They think they are buying safety. They are buying obsolescence. Think about the implications for the geopolitical balance of power. Russia is essentially a gas station with nukes. If the gas station goes out of business, what happens to the nukes? What happens to the stability of the regime? Saudi Arabia is racing to diversify with Vision 2030 because they see the writing on the wall. They know the oil era has an expiration date, but can they move fast enough? Or will we see a wave of sovereign defaults across the commodity-producing world? This isn't just about the price of a bushel of wheat. It's about the stability of the global order. When the money stops flowing out of the ground, the politics gets dangerous. Civil unrest in South America. Regime changes in Africa. Budget crises in Australia and Canada. The map of the world changes when the money moves. And the money is moving. It is moving from the physical to the digital. From the heavy to the light. From the volume to the efficiency. The supercycle was a nice story. It made people feel safe. It made sense in a 20th century worldview. More people equals more stuff. But we are in the 21st century now. And the rules of the game have changed. The correlation between GDP growth and material consumption has broken. We can grow value without growing volume. That is a miracle for humanity. But it is a catastrophe for the commodity bulls. Let's look deeper into the mechanism of this trap. Why do smart people keep getting this wrong? It's because they confuse need with demand. This is a critical distinction. Need is what you require to survive. Demand is what you can pay for. Billions of people in Africa and India need more infrastructure. They need more steel. They need more energy. So the analysts put them in the spreadsheet. Look at India, they say. India is the next China. Africa is the next India. But this assumes that India and Africa have the same purchasing power, the same centralized government control, and the same credit capacity that China had in 2000. They don't. China was a unique historical anomaly. A command economy that could force banks to lend trillions to build empty cities just to hit a GDP target. India is a messy democracy. It cannot force-feed infrastructure in the same way. It cannot command demand. So while the need is there, the solvent demand is not. The commodities will stay in the ground, because the check will bounce. Furthermore, look at the currency aspect. Commodities are priced in US dollars. As the US economy stays stronger than the rest of the world, driven by tech and AI, the dollar stays strong. A strong dollar crushes commodity demand in emerging markets. It makes oil and copper more expensive for India, for Turkey, for Argentina, so they buy less. It is a feedback loop. The stronger the US tech sector gets, the stronger the dollar gets, the weaker the commodity demand gets. It is a suffocating mechanism, and there is no easy way out of it. Unless the US dollar collapses, commodities have a massive headwind. And with the US being energy independent and the leader in AI, betting against the dollar has been a widowmaker trade. Let's recount the battlefield. On one side, you have the bulls, armed with old maps, armed with the memory of the 2000s, armed with the supercycle theory. On the other side, you have the bears, armed with the reality of demographics, armed with the efficiency of technology, armed with the inventory data, and armed with the truth about China. The battle is already over. The bulls just haven't looked at the scoreboard yet. The prices are drifting lower. The highs are getting lower. The rallies are getting weaker. Every time there is a geopolitical scare, a war, a sanction, prices spike for a week, and then bleed back down. That is the behavior of a bear market. That is the behavior of a market with no structural support. So, what happens next? We enter the era of the Great Optimization. Companies that can do more with less will win. Countries that sell intelligence, services, and high-end manufacturing will thrive. Countries that just sell rocks and fluids will struggle. We will see a divergence in the global economy. The physical South versus the digital North. The tension between these two worlds will define the next 20 years. And for you, the investor, the observer, the citizen, it means you need to change your lens. Stop looking for the next gold rush. Stop waiting for the inflation of the 1970s to return. Look for the deflation of the 2030s. Look for the companies that are destroying demand, not the ones hoping for it. The silence you hear in the mines is not a pause. It is a retirement. The machinery is rusting. The pits are closing. And the world is moving on. The commodity supercycle isn't asleep. It's dead. And the sooner we accept that, the sooner we can prepare for what actually comes next. Let's pause and really visualize the consequence of this. Imagine a town in Western Australia, or a mining outpost in northern Chile. For 15 years, this place was the center of the universe. Truck drivers making $200,000 a year. House prices rivaling Manhattan. Everything imported. Champagne. New trucks. Hope. Now, walk through that town today. For sale signs on every lawn. Equipment auctions every weekend. The young people have left for the cities on the coast. The old people are stuck with assets that are depreciating every day. This is the Rust Belt of the 21st century in the making. Just as the steel mills of Pennsylvania emptied out in the 1980s, the resource frontiers of the world are emptying out now. History rhymes. Capital is ruthless. It goes where the growth is. And growth has left the building. But there is a twist. A final irony. While the price of commodities stays suppressed, the strategic importance of them might actually increase for governments. This sounds contradictory, but stay with me. Because prices are low. Profitability is low. Because profitability is low. Private companies stop investing. They stop exploring. Capex crashes. 10 years from now, we might actually have a supply crunch, not because of a supercycle, but because we starved the industry to death. We broke the machine. And when that happens, it won't be a market boom. It will be a crisis. Governments will have to step in. We will see the nationalization of resources. The U.S. government might have to subsidize copper mines just to ensure national security. Not for profit, but for survival. The market mechanism is failing. We are moving from a free market in commodities to a managed, strategic, subsidized market. That is a very different game. You don't invest in that. You survive that. Think about the farmers. Agricultural commodities are part of this too. Technology is hitting them just as hard. Lab-grown meat. Precision agriculture using drones to spray fertilizer drop by drop. Vertical farming in cities. The demand for vast tracts of farmland and millions of tons of fertilizer is under threat. The peak farmland theory suggests we might actually return land to nature in the next 30 years. Again, great for the planet. Terrifying for the potash producer. Terrifying for the tractor salesman. The narrative of 8 billion mouths to feed means high wheat prices ignores the fact that we throw away 40% of our food. If AI supply chains fix the waste, we effectively double the food supply without planting a single extra seed. Efficiency is the invisible supply shock, and it is hitting every sector at once. This is the convergence. The convergence of AI, demographic decline, and circular economics. They are three horsemen of the commodity apocalypse, and they are riding together. Most people only see one. Oh, China is slow. Or, oh, AI is cool. They don't connect the dots. They don't see that AI causes China to need less stuff. They don't see that circular economics is the response to demographic decline. It is a self-reinforcing system, a spiral, and it spirals down. Down towards lower costs, lower prices, and a world where physical stuff is cheap. But attention, data, and trust are expensive. We are witnessing the flipping of the hierarchy of value. For 5,000 years of human history, land and resources were the ultimate wealth. Kings fought over gold mines. Empires fought over spice routes. Nations fought over oil fields. Now, the biggest companies in the world own almost no physical assets. Google, Microsoft, Nvidia. Their wealth is in the code, in the chips, in the network. The physical world has become a utility. Necessary, but not valuable. Like water. You need it to live. But you don't get rich selling it in a rainy city. And folks, it is raining. So, here we are at the end of the argument. Let's look at the scorecard one last time. Myth 1. China will rebound. Verdict. Busted by demographics and the end of the construction era. Myth 2. Tech needs more stuff. Verdict. Busted by efficiency, miniaturization, and substitution. Myth 3. We are running out. Verdict. Busted by deep-sea mining, fracking 2.0, and better exploration. Myth 4. Inventories are critically low. Verdict. Busted by the just-in-time logistics and shadow stockpiles. The conclusion is inescapable. The supercycle is a ghost story. It's a story told by people holding heavy bags, hoping you will buy them. Don't be the exit liquidity. We are entering a time of the great boring. Commodity prices might just flatline, drift, stagnate for a decade. No crash, no boom. Just a slow, grinding erosion of value adjusted for inflation. That is the hardest environment for a trader. Volatility kills. But stagnation suffocates. It suffocates the debt-laden producers. It suffocates the fiscal budgets of petrostates. It suffocates the narrative. But in this destruction, there is creation. If raw materials are cheap, who wins? The builders win. The manufacturers win. The creators win. A world of cheap energy and cheap metal is a world where it is cheaper to build the future. Maybe that's the silver lining. The commodity crash paves the road for the abundance age. We stop worrying about running out and start worrying about what to do with the plenty. That is a better problem to have. But it is a painful transition. And we are right in the middle of the pain. So, I have to ask you, when you look at your portfolio, when you look at your career, when you look at the news, are you betting on the past? Are you betting on a world of scarcity and hoarding? Or are you brave enough to bet on the future? A future of efficiency, of intelligence, of doing more with less. The tide has gone out. The old shipwrecks are visible. Don't try to sail them. Thank you for watching. If this video challenged your worldview, if it made you rethink what you know about the global economy, then we have done our job. This is a battle of ideas, and you need to be armed. There is another history being written right now, one that isn't about rocks and oil, but about the collapse of the systems that relied on them. Click this video here to understand the geopolitical consequences of this crash in more detail. It's the next piece of the puzzle. I'll see you there.